Governance, or the G in ESG, covers a wide range of issues that can also be considered environmental or social concerns, depending on how a company, investor, or entity categorizes it. For example, supply chain management touches upon environmental and social issues, yet the management of a supply chain is ultimately dictated by those in positions of senior leadership. Let's go through some of the more dominant governance issues you should be aware of. Board quality, diversity, and effectiveness. The qualifications, accountability measures, and overall approach to counseling management to execute on multi-year strategies, including the integration of ESG factors into risk management and business planning, are key governance concepts. As large enterprises serve diverse markets, board diversity supports the successful engagement of diverse customer bases. For example, as companies enter emerging markets, a homogeneous board of directors will most likely engage in groupthink, reducing innovation and the ability to comprehend the needs and opportunities within diverse customer bases. Investors are increasingly looking at DEI as a critical benchmark and are looking for more comprehensive execution of DEI strategies. Reporting, transparency, business ethics. The comprehensiveness, the accuracy, and the consistency of ESG reporting disclosures are essential to both investor confidence and valuations, in addition to consumer and stakeholder trust. Heightened public scrutiny in corporate supply chains and social media have made transparency the new normal for both consumer-facing and B2B businesses. As consumers increasingly desire information on product sourcing, production, and labor, a company withholding this information will lose these customers. Investors will also make consequential assumptions about a company's management quality and intrinsic value when limited product or company information is publicly available. As an analyst, the extent of their disclosures and reporting should indicate the extent of their thinking around these issues. The leading and most credible disclosure frameworks include the industry-specific standards from their Sustainable Accounting Standards Board, SASB, and the cross-industry recommendations laid out by the Task Force for Carbon-Related Financial Disclosures, TCFD. The Global Reporting Initiative, or GRI, is another globally recognized and used framework for disclosing progress on ESG issues and complements SASB and TCFD. Executive compensation, long-termism, and ESG integration. As an analyst, if you see an executive compensation structure tied to environmental and social benchmarks and an ESG committee at the board level, you can be sure they are fully integrating these issues into their enterprise risk management system and long-term planning. ESG integration, or the process of systematically integrating ESG issues into daily business operations, is the single most important insight to deliver as a financial analyst. If a company does not have ESG as part of its enterprise approach to governance, it's likely they aren't fully assessing their risk exposure to these issues. A company's overall approach to governance, regardless of which category issues are placed in, can either enhance the following essential business outcomes or damage them. Stakeholder trust and license to operate. Consumer trust in corporations and institutions in general are at historic lows. B2B customers are now accountable for the behaviors of their supply chain partners. Employees no longer spend an entire career at a single company. Enhanced governance directly impacts the trust necessary for stakeholder confidence and license to operate. Back to that Nike controversy, their lack of accountability and due diligence regarding who they contract with led to institutional customer losses, consumer boycotts, and significant investor concerns about their license to operate both domestically and abroad. Enhanced risk management. ESG integration provides greater sensitivity to changing market and non-market conditions that could negatively impact business continuity, including stakeholder opposition, boycotts, or government fines and litigation. Long-term value creation. Integrating ESG factors into enterprise risk management and corporate strategy supports the organizational adaptability and resilience required to adjust to shifting economic, environmental, and social conditions. This supports identifying opportunities for long-term value creation by identifying new markets, customers, and unmet needs. For example, Unilever generates more than half their sales from emerging markets, selling personal care, sanitation products to middle-class populations. Their existing distribution network and local infrastructure enabled Unilever to access a completely new segment of low-income customers with a product and price point that improved customer outcomes and corporate profitability. Let's look at the tools and processes companies undergo to even decide where to start in developing an ESG strategy. Let's dive into materiality. When assessing ESG disclosures, you as an analyst will always want to determine whether the company has undergone a materiality analysis. A materiality analysis is the process of identifying the ESG issues most impactful to a company's business success and most important to its stakeholders. Understanding a materiality analysis enables you to get a glimpse into their perspective on high priority concerns and the risks that they consider to be most material to business success. As an analyst, the stakeholder aspect provides you with an idea as to where opposition may lie and the extent of material risk associated with these opposing stakeholder interests. If a company hasn't undergone a materiality analysis, it's safe to say their approach to ESG is less mature, and they don't have a holistic understanding of the relevant ESG priorities they should address. There's no uniform approach to a materiality analysis outside of the content for the two axes: impact on business success and importance to stakeholders. As a financial analyst, you can use the materiality assessment to get an idea of where a company sees its greatest risks to the business and the welfare of its key stakeholders, and you can leverage the analysis as a tool for measuring the efficacy and maturity of the company's work on ESG in general. We've gone through some very specific examples of how an environmental, social, and governance issue can inform potential risks and opportunities. Now let's explore what happens when multiple environmental, social, and governance issues across categories converge in real time. Although ESG issues are neatly packaged into three separate categories, the reality is that they often converge to create novel risks that reverberate across supply chains, interdependent industries, and entire communities. As social and environmental issues collide, the quality of governance is the determining factor in treating changing market and non-market contexts as both risks and opportunities. In addition to novel risk, comprehension and identification of material ESG issues can unearth unmet customer bases and markets, product innovation, and new business models adapted to these changes in market and non-market factors. For example, a food service company who relies heavily on animal protein revenues could see their raw material input costs increase due to water scarcity and rising costs, and rising temperatures could require increased expenditures for their manufacturing plant refrigeration systems. These issues are risks to their key revenue streams, but also present unique opportunities. As consumer preferences for plant-based proteins continue to grow exponentially, this food service company could capitalize on this trend by integrating plant-based proteins into their key offerings. Not only does this capture an emerging customer base and capitalize on a consumer preference change, but it also reduces the amount of water required for production and reduces the amount of refrigeration and associated power needed to store these products.